Hi everyone, it's Brad Gilbert, and I'm back for part 3 of how do bankers trade Forex. And this is all about fundamental analysis, the key fundamental drivers of the market that gives the currency's direction. Now, for those new traders who have been sort of either Googling around or looking at indicators and using that for their general trade direction or entry levels, you've got it all wrong, right? The whole financial market system, whether it's Forex, derivatives, futures, anything, it all comes back to the economic data, the fundamental drivers. Now, there's a number of key components to this that you need to understand. And it really does start with the central banks. Once you understand the central banks and how they read the economic data, well, then what you can do is you can forward project their thinking by looking at the economic numbers and then reacting to what those outcomes are from the forecasts. So this is all, it may sound really complicated, but it's not. And you don't need an economics degree to grasp the concept. It's all about actual versus variance. And what I'm talking about there is with the central bank meetings, as well as the economic data releases themselves. The market projects the forecast and then reacts to the actual outcome. And that's the way the financial markets works. It's very simple, right? But it does get complicated when there are certain things like geopolitical events, Brexit, for instance. Donald Trump is creating all sorts of issues with this new tax reform, also creating issues with North Korea, et cetera, et cetera. You get the picture. Those geopolitical events blow out the general flow of the economics or the key fundamental drivers, which is the central banks and the economic data. But you take those geopolitical issues out, that's when you get good trending markets, and that's what we've sort of got at the moment with the Fed, right? They've been raising rates. It gives us a general upward bias sentiment, positive tone for the US dollar. Now, all we have to do to look for those really low risk, high probability trading opportunities is to look for the data that matches the central bank sentiment. And that's strong numbers, strong US numbers. You get that picture and then you overlay with your technicals, and we're getting very close to the overall big trading picture and methodology that you need to adopt, right? It doesn't mean you can't include specific indicators and these things in there to enhance your probability of success, but the fundamental drivers, the fundamental analysis, okay, and I know a lot of traders out there, or a lot of educators for that matter, tell you to stay away from the fundamentals, and that's primarily because they've never actually learned them. They don't understand them, they never worked in the banks, and anyone that actually says that, ask yourself the question, how much experience have you really got? All right, so what I'm going to do is just run you through a general slideshow. It's easy to explain the concept of the fundamentals through that. And then once we've gone through the slides, I'll come back and I'll show you where we sort of really connect to the market. Right? It's using a product, one of Reuters products, Reuters Zenith. This is where your connection to the market with the news, the real-time economic data releases, and just the general momentum of what's going through the market. All right, I'm sure this is going to be a bit of an eye-opener for you. So sit back and relax. It won't take long. I'm not going to talk longer than I need to, and we'll start with a slideshow now. All right, here we go. And as I said, for a lot of new traders, this is going to be a bit of an eye-opener for you, and it will really explain why the markets go up and down. All right. Now, what do the fundamentals provide the answers for? Well, pretty much everything. Your trade decisions, whether you're going to buy or sell, it all comes from this epicenter, the fundamentals. The market determines and dictates what you do and when you do it. And it comes from the fundamentals themselves. And these, because of that, because you're getting the actual time to trade and the direction, whether you're buying or selling, this is absolutely critical to your overall success. If you don't understand this, well, you know what? You can have some limited success, but you're not going to be a full-time professional trader. It's key you get your head around this area. And why? Once again, it all comes back down to currency direction, right? Now, there's no need to sort of guess, are the currencies going up or are they going down? Look at the fundamental drivers. It will tell you it is going up or it is going down or it's going sideways. And that's when trading becomes easy. Okay, as I mentioned, there's three main components which make up the overall fundamental analysis. Okay, you've got the central banks, the geopolitical issues, and then most importantly, also right behind the central banks, the economic data releases. Now, imagine these things going into a cylindrical cone like the picture here. Now, if there's no sort of major issues, they will flow straight through and give you nice trending markets. If any one of these areas is uncertain or discombobulating, well, then they're not going to really come out, maybe sporadically. And that's pretty much the way the market works. If we get nice conditions for these three components, we get really nice trending markets. If we don't get those conditions, well, then trading's going to be a little bit patchy. And you have to understand your performance comes back to what the market gives us. And that's why the fundamentals are so important. Now, first of all, central bank announcements. Okay, now we've got the sort of 8 sort of major central banks connected to the, like the G8, the big currency pairs. Okay, the Reserve Bank of Australia, ECB, Bank of Canada, Bank of England, the Fed, the epicenter of all financial markets, Bank of Japan, the RBNZ, and the Swiss National Bank. Now, these central banks, they meet every 4 to 6 weeks, and it is very important you understand how they work. As I said, the trends, market direction comes specifically from the central banks. Now, who's the most important? Well, it starts at the top. The governor, the president, the person in charge is the most important person to us as traders. And when they are speaking, we listen. They're the ones that deliver the statement after the interest rate decisions, and they're the ones that probably have the balance of power on interest rates themselves. So it's very important we understand what they're doing. Now, why are the central banks so important? Well, they reset sentiment at each meeting. Okay, what they do is they go into the meetings themselves, they discuss the overall economic conditions the past month, and then they work out through a number of guides, whether it's an inflation guide, which generally, historically, they've had a band between 2 and 3%. If interest rates, if inflation goes above 3%, they would raise rates. If inflation went below 2%, they would cut rates. And that sets the tone for the currency for the next month until the next meeting, right? So that's where we can get clear sentiment changes. And when we do, they are huge trading opportunities. Now, let me just wind that back just a touch. Now, there's 3 major ways or that people or traders categorize the sentiment from the central banks. Okay, a hawkish tone, well, it's a bullish bias. Okay, they're talking the prospects of rates up. A bearish or dovish tone, a dovish tone is bearish. Okay, they're sort of thinking, well, things aren't looking so good, we may have to cut rates. That would be dovish. If they're neutral, like they basically say, look, economic conditions aren't changing, there's nothing to do, well, then that's a neutral tone and there'll be no bias out of the meeting. That could be a good trading opportunity or not. But generally, when you do get a bullish or a bearish tone, okay, that's when we get some serious big moves in the market. But now, understanding the sequence of the central bank releases is very important, right? They have their meeting, and out of that meeting, at the same time, comes a rate decision and a statement. Usually, a week later, you get the minutes, which is more detailed analysis of the overall statement and what was actually said in the meeting. But the 2 most important things are the rate decision and the statement itself. They're the 2 things you need to focus on. So, how do the central banks link all the data together? Now, I've sort of just briefly mentioned it, but let me just run through that again. So, at the central bank meeting, you have the rate decision. Then you also get the statement released at the same time, explaining what they did with the rate decision, whether it's a hike, a cut, or neutral, and what their forward projections are, what they think they're going to have to do next month, right? And out of those 2 features, right, you get market sentiment. And that's very important because that's what we're looking for. We want the direction from the central bank. This is where the core overall trends come from in the market. Right, so where do those economic data releases come into play? Well, basically, the central banks each month, they piece together the economic numbers, and that's where they determine the next rate decision or statement. If we see really strong economic numbers, okay, around the big key data that they look for, retail sales, employment numbers, CPI, manufacturing, these sort of components, that leads them into the next interest rate decision. And that's why traders watch those economic data releases closely, because they actually know what the central bank is going to do, because in the previous statement, they tell them what they're going to be looking for. Okay, now the central bank sentiment itself. The first 2 weeks of every month are usually very clear. right? That's because we've just got a fresh statement from the central bank. It will tell you specifically, we're looking at employment, we're looking at inflation, we're looking at average earnings, all these various components. So after the news is released, for the first 2 weeks, right, the market is very focused on that. But that sentiment over the course of the month fades. Okay, once you get closer to week 4, and so some of the central banks, they have their meeting every 6 weeks. As it gets closer to the next meeting, traders let go of the previous sentiment. They're now focusing on the economic numbers in front of them and forward projecting the next sentiment out of the central bank. Okay, so understand that. Straight after the meeting, the first 2 weeks, very good for direction. After that, it starts to fade as traders focus on the next meeting coming up. Now, if you're thinking of just jumping in and trading these central bank meeting announcements, well, you may want to think again, because there's a number of variables here that come out. Okay, now with all the quantitative easing we've seen over the last 7 or 8 years, there's a whole heap of things to consider. There's the interest rate decision, there's lending facilities, you've got all the quantitative easing components. But what you're really looking for is the rate decision, statement. Then they generally have a press conference about 45 minutes later in the way that ECB do it. So you've got variables here. This isn't as simple as trading an inflation number or a GDP number or a retail sales for that matter. There's a number of things to consider. And when they have press conferences, that can get a bit convoluted because they have a chance to generally talk things up. And then the next sentence, they can talk things down. So just be aware, sometimes the best trading opportunity, if they're not changing interest rates, is probably after the event. Like I'm talking about half an hour or an hour afterwards, right? You're going to miss a lot of the volatility around that. You may miss some of the moves, but I can tell you what, you're going to save yourself a few bucks as well. Now, what's so important about these central bank meetings? Okay, let me just wind it back even a touch further. The average daily range for the major currency pairs is 150 points in a day. Now, that really comes from the central banks. If the currencies generally move 1% over the course of a day, the central banks would usually intervene to slow the currencies down, right? And that's a key component that a lot of people don't get, right? So, but on a central bank meeting, right, they're making the announcements. They want the impact so that they don't slow the market down on those days. And if they change policy or announce something unexpected, you can get absolute massive moves, generally around the 250 to 300 point mark, right? So understand on a massive economic data release, we may see 150 point movement in the currencies. On a central bank announcement, it's much bigger and the potential for big gains is there, right? Now, just on these charts, I'm going to give you a couple of examples here. The RBA, okay, surprise interest rate hike, cut, sorry, the 160 point move to the downside. And then flowing from that, right, that was a change from raising rates to neutral to now cutting. That's a change in sentiment, which is in the market for some time. And the follow through was another 500 points to the downside. And that's why these announcements are very important. Now, you might have missed the first announcement itself in the Aussie here, but you can see you get back in on a rally and then you're looking for the next major move. An ECB surprise rate cut, same situation. Initial move on the announcement, 220 points, right? Then we look for the retracement and then it starts to drift off from there as well, right? This is the same with all the major currency pairs. The Fed, okay, disappoints with no tapering. So what we see straight after the move, 130 point move quickly to the top side, okay, it takes about 3 hours, and then it starts to drift sideways after that. This sort of change in sentiment from the central bank is very important, and it's important that you understand what it means for after the event. So sometimes it's either going to trade sideways or it's going to continue in the direction that it's actually just moved. All right, now let's just get on to the economic data, right? This is what the central banks are looking for. And the easiest way to think of it is they are the fundamental drivers of the currencies, right? This is what the central bank looks at to make their decisions. So traders trade the high impacting ones very aggressively because a variation in that data will lead to a repositioning of the central bank sentiment for the upcoming meeting. Okay, so the key ones, interest rates, CPI, industrial production, employment numbers, GDP, PPI, retail sales. Okay, they create market volatility and specifically currency direction for the currencies. They give the currencies immediate bias and direction. But not all economic data is the same. There is a general hierarchy, right? The interest rate decisions from the central banks are at the very top, of course. You've got the consumer price index. Historically, the central banks have used the CPI or inflation to determine whether they raised rates or dropped rates. In this day and age, they are now looking towards employment and average earnings as two extra indicators to make those decisions because inflation has been so weak for so many years. GDP numbers, it's a big heavy-hitting number. It's the overall health check of the economies. Retail sales, a key component of consumer confidence and spending. Unemployment rate, obviously a massive component of the whole economic structure. Any sort of weakness in unemployment should go into weaker further retail sales and inflation, etc. And then you've got overall consumer confidence. Okay, now that can be sort of quite fluctuating, especially around major geopolitical events, but it is another key component for some of the big economies. So back to the economic data releases. They create immediate bias. As I mentioned earlier, the central banks, right, they tell you, we are looking at these specific numbers, and if it increases or decreases, we will do X, Y, or Z. They tell you exactly what they're going to be looking for. So when these numbers come out and there is variance straight away in the number, okay, the currencies move very aggressively because they act as though that would mean an interest rate cut if the number is weaker. Like this CPI flash estimate for the euro, it's weaker than forecast. That would mean a potential ECB cut or negative sentiment, so the euro drops off and traders sell aggressively. And this is the same for all the major currency pairs. And that's why the economic numbers, the fundamental drivers, are so important for all of this. Now, I don't want to get you confused with this. Now, current bias in the market, right? There's three major sort of types of bias. You've either got upwards movement, okay, upwards bias, sideways bias, or downwards bias, okay? Now, this is different to the overall trend. So what I want you to understand is there's a major component here. These are the economic numbers. The economic numbers will create the short-term bias. But the longer-term trend, okay, that will come from the central bank. In this example here, I've got the Aussie dollar, we've got the RBA. They've got a hawkish, positive sentiment in the market. As I said, the best trading opportunities are those where the economic numbers actually go with that longer-term bias, the longer-term trend set by the central bank. It doesn't mean that there's not short-term trading opportunities on numbers that are against that trend, but just be aware they are short-term trading opportunities. Where are the longer-term trades? Well, those longer-term trades are around the central bank announcement on interest rates and then also data that runs with that sentiment. Okay, you put those two, short-term bias and long-term sentiment together, that's where we get good trending markets and we make a lot of money very quickly. We haven't seen a huge amount of it lately, and that's why the US dollar at the moment is so exciting, because we've got a positive dollar sentiment. The Fed are looking to raise rates. We've got a new Fed chairperson, Jerome Powell, starting early next year, and we get a whole new sentiment from them, and it is quite hawkish. So that gives us something to trade against, especially with the majors, because the US dollar is the benchmark for most major currency pairs. All right, now let's get into where things go a little bit pear-shaped. Okay, and this is what we've seen a lot of over the last few years, is major geopolitical events drifting into the market. They completely discombobulate the technical side as well as the fundamental side, and the markets turn to crap, right? It's because of these issues. Now, let me just explain sort of what they are. Well, firstly, okay, just understand that they actually can be good trading opportunities. You can get huge moves, but around these things, just understand there's a huge amount of risk, right? That's mainly associated because we don't know when they start, when they stop, who's saying things, and the volatility increases. So yeah, there's a lot of cash you can make in these, but just don't go in with all your capital because you can get your arm bitten off very quickly. They're usually broad-based events. As I mentioned, the US is the major market or economy in the world. So a lot of weird things coming out of the US, especially around Donald Trump. since he's been elected president. Terrorism events are another major problem. Then we've also got situations of global debt, whether it's US, European, or just anywhere for that matter. Everyone's got a load of debt these days. So they're broad-based events and they can hit various markets. Now, for instance, the growing US debt has been an issue for some time now. And when it comes into focus, okay, we can see it impact the US dollar, and movement around that dollar becomes quite erratic and hard to predict. And that's when trading does get a little bit pear-shaped. Also, another good example of where things can go pear-shaped, the UK exit from the EU, otherwise known as Brexit. Right? This has been an absolute nightmare because the announcements, unlike the economic data releases and the central bank announcements for that matter, the announcements around these geopolitical issues are random. They are not forecast, they are not scheduled. You get random negative and positive remarks and the currencies take off in all sorts of direction and you don't know where the flow is coming from. You get taken out of positions, both sides of the market. They are really not good for trading. Okay, I just want you to understand geopolitical issues. You might think, yeah, there's great big moves, but they are a nightmare. And what happens is generally the normal flow of the majors in particular will break down. So you'll have a situation where the fundamentals, you've got traders buying US dollars and you've got traders buying euro. Now, what does euro against the dollar do? Well, it doesn't do anything. It sort of trades sideways in a really erratic, choppy fashion. And that's what can happen when there are various geopolitical issues happening at the same time. So currency direction is definitely not clear around these events because when you get these random announcements, you don't know whether they're true, whether it's been confirmed that the actual person said it, does it actually mean anything, all these various things. You don't know when it starts and when it ends. And that's a big problem for traders. When these geopolitical issues pop up, traders pull out. Okay, they stop trading and they wait. And that's where liquidity even gets a little bit looser from there. So what do we need to do? You need to follow the market, right? If you want to be a professional trader, right? I'm not saying you want to go in there and start buying orders straight away, but you need access to the market, live real-time news. And I'm talking about economic data releases as well as the news itself, efficient trading systems that you can look across various markets because most of these markets are connected, as well as your technical analysis. As I said, this is Reuters Zenith that I have a screenshot of. I'll show you this system in a minute. It allows me to observe the market and check things out very quickly and efficiently. And I know when I see things, what time it came out. Because if you see a potential move in the market and you didn't know when it happened, well, you could be getting at the end of the move instead of the start of it. So the closer to the release, especially on general news or geopolitical issues, you need to know when that comes out and what the news is around it. And that's the way you sort of piece everything together. That's how you trade. Once you understand the fundamentals, you will become an independent trader and not need to rely on anyone. So you combine the fundamentals, right? The central bank sentiment, the economic data releases, and then throw on top of that some of those geopolitical issues if they are around, and that's where you'll get the overall market sentiment. As I said, you take out the geopolitical issues, the central bank sentiment and the economic data should give us nice trending markets, okay? But you've got to remember there's three components. Consider all of them when you go to trade. All right, and that's pretty much it. I'll switch over now to Zenith. I just want to give you a bit of a look at this. And then if you have any questions, of course, email us at info@tradersfortraders.com or anyone on the as part of the membership. Obviously, jump into the 247 trade zone and you can ask some questions in there. The fundamentals, as you guys will be aware, are a major part of the course and then a major part of the daily analysis that we provide through the market sentiment and the charts every day. And the sooner you get up the curve on this, the sooner you're going to become an independent trader, as I said, and your profits will change dramatically because you'll be trading with the market, not against it. Okay, now I'm going to take you over to show you Reuters and show you how the fundamentals work in the real world. Okay, this will open your eyes to a new product, new information. It's going to be quite exciting. Just give me 1 minute. $99 a month product. It's the cheapest thing that you'll make money out of everything you'll buy probably in your lifetime. Okay, it provides the direction, and it also has the technicals in here as well. But what I want to show you is just how the market works and how it connects to everything. So you've got general overall news here. I've got a number of templates already set up. It allows me to read quickly through the market. So this one up the top here is market news. It will give me details on the major currency pairs across all the markets for that matter, but mainly on Forex, the one I've got set up. This one here will give me breaking news, any news that flashes up, or I've got commodity news here as well, which is in the news these days, especially with regards oil and Canada. All right, so you come back and look at a page like this, and I have templates built that will give me in-depth news and analysis around each currency pair. Now, I've just clicked on my US dollar template. Now, I've got the news up there for all the US dollar news. I can actually sort of review that for the week, so I can prepare myself for when the major momentum shifts may occur. I've got charts here. I've got a real-time news there as well. Anything that comes up in the US dollar will pop up there as well. Okay, you can follow, what you end up being able to do is follow the market technically and fundamentally, right? Whether it's general news or updates, or give you a general rundown of when these economic data releases are coming out, what the real-time numbers are, right? And that's where that short-term economic bias comes into play. And it's very important that you understand this to become a professional, independent, successful trader. So the economic data releases, right? If you're looking at something like Forex Factory, Daily FX, FX Street, now they've got nice calendars and they do tell you what's coming out, but the news is not released in real time. If you're like 5 seconds behind the news, it's too slow, right? So you need to get a service that actually does correspond with the market and give you detailed description and analysis of what is going on. Then the benefit of having this actually is as well, a lot of people sort of say to me, well, where's the sentiment for the central banks, right? I can tell you where it is. You go looking for it, you go shopping, okay? You will find out where the central bank sentiment is. And I've got all the various pages here. Okay, I can go and click into any of these and start to find more details around the specific central banks themselves. Okay, interest rates, the latest data releases, the target rate, inflation, everything is here that you need to work out, is the US dollar going up or is it going down? Now, you should be able to work that out pretty quickly, okay, how this all works. Because once you've got the fundamentals, it's very important to start overlaying the technical analysis on top of that. As I said, it won't take long. If you go through the Pro Trader course, I was just going to say, like, just get your head into the market, but go into the Pro Trader course, right, go through the central bank sentiment and the way they release their information. As I said, this is the key part of the market that you don't want to be asking me a question in the trade zone. As you get more successful, you'll be able to see the announcement and trade it, right? Interest rate decision changes themselves are very easy, right? But understand, you need to sort of have a very good indication of what has been factored into the market. So when the central bank does something, if it doesn't match up to the forecast, you know what to do, whether to buy or sell. And that's where you're going to make a lot of the money. Now, if you're not that far up the curve, well, then you can come back to actually just trading the announcements like 10 minutes afterwards. You don't need to get in at the raw end of the release. As I said, there's a lot of volatility. You can get a huge amount of the move if you get in early. But if you don't know what you're doing, just wait. Because the central bank announcements, when they do change interest rates or policy for that matter, it isn't just a one-day move. It's a month move. It sets you up for the next 4 to 6 weeks, and that's why you need to understand those. Understanding the economic data releases, well, they're quite simple. It's all about actual versus forecast, okay? And the course will take you through that very in detail, right? You should work out very quickly where these opportunities are. But don't get fooled into thinking that you can just trade every economic data release, because there's a huge amount of volatility around the high impacting ones. And you just got to make sure that you are going with sentiment. Don't sort of second guess it, I was going to say, but don't overthink it and overtrade the data. Look for sentiment, match up the data, you trade. It's simple. All right. Then last but not least, always keep an eye out for those geopolitical issues. If you're reading my Market Insight each day, you will see that I'm a little bit bitter about when those events pop up. And it's because they ruin the market. They ruin the initial sentiment. We could have, for instance, we could have really nice central bank sentiment, which is, say, down, for instance, economic numbers weak, and then you get some crazy announcement which sends the currency higher and blows everyone out. I can tell you the geopolitical events are a nuisance to all professional traders. And that's why the Donald has been a bit of a pain in the backside since he's been elected, because he is a geopolitical storm, right? He loves creating issues because it deflects attention away from himself. And that's, if anything, made trading the US dollar a little bit harder. The US dollar is the benchmark for all major pairs. So trading has been a little bit sporadic occasionally because of the Donald, his influence over the markets themselves. All right, so that's the fundamental analysis, guys. I hope this has explained a lot of the intricacies. As I said, the Pro Trader course will give you more in-depth detail. If you're not sure about anything, send us an email at info@tradersfortraders.com, or get onto the trial there and jump in the trade zone. Ask us questions. We're here to help. We're here to make you a successful trader. Thanks for joining us, and we'll see you again shortly. Cheerio.